On my channel. Today we'll be doing a quick portfolio update followed by a look into the buys that I made this week and looking at one specific company in particular, that is ADC, Agree Realty. So without further ado, let's dive into the portfolio. As you can see, my portfolio has a value of about $45,700. The performance over the past month is up about 3%. The past 3 months is up about 6%. Over the past year, it's up about 18%. And overall all time, which is about a year and a half, is up about 9%. Scroll down and look at the specific companies that I have. So here we can see I have Apple, about 14.5 shares of Apple, a market value of $2,600, about 26% on Apple. Scroll down, we can look at Agree Realty. Like I said, we'll be looking at Agree Realty and why I bought into this company later in the video. So as you can see, I bought 6 shares. I'm basically break even here, and it cost me about $400. American Express, I have about 10.4 shares of American Express, market value of $1,800, about 16% or $250. Bank of America, I have about 48 shares of Bank of America, market value of almost $1,400, up about 2.7% there, which is about $40. Scroll down, we can see we have Brookfield Corp. I have about 49 shares of Brookfield Corp, market value of $2,000, and then is up about 1.3% or $28. Costco, I have about 2.7 shares of Costco, market value of $1,400, up about 21% here, which is about $250. CP, I have 24.7 shares, market value of $2,500, up 8.72% on CP, which is about $200. CSX Corp, I bought into last week. I bought about 13 shares, market value of $420. I'm up about 5% here, which is about $20. Home Depot, I have 3 shares of Home Depot at a market value of $902. Basically break even here. JP Morgan, I have 12.25 shares of JP Morgan, market value of $1,700, up about 23% on JP Morgan, which is about $330. Lowe's, I have 6.3 shares of Lowe's at a market value of $1,350, up about 8.73%, which is about $100. Manulife Financial Corp. I have 50 shares of MFC, market value of almost $1,300. Basically break even here. Microsoft, I have 13.7 shares of Microsoft, market value of $4,500, about 26% here, which is almost $1,000. NSC, I have about 4.3 shares of NSC, market value of $900, up about 3% here or $30. Realty Income, I have 17 shares of Realty Income, market value of $1,000, basically break even here. Royal Bank, I have 14.3 shares of Royal Bank, market value of almost $1,800, and basically break even here as well. TD, I have about 42.8 shares of TD, market value of $3,300, down about 7.4% on TD, which is about $273 in the red. T. Rowe Price, I have about almost 9 shares of T. Rowe Price at $980, down about 5% or $53. Texas Instruments, almost 10 shares here at a market value of $1,700, up about 6.8% or $111. UNP, I have about 5.2 shares of UNP at a market value of $1,050, basically break even here. Visa, I have 6.7 shares, market value of $1,500, up about 14% on Visa or $195. Vici Properties, I have about 17 shares of Vici at a market value of $545 and about 2% here, which is about $14. So the securities here in the US, they're actually stated in US dollars as it says USD, and then the ones in Canadian are stated in CAD or Canadian dollars. Now, let's go and look at the buys that I made this week. So basically the buys that I made this week, I had a fractional buy of Microsoft. That was just from the dividend that I got from Microsoft, and it's set up on a drip. And then ADC, Agree Realty. So I started a position in Agree Realty, makes up about 1% of my portfolio now, with a goal of making it up to about 2 to 2.5% as opportunity presents itself and as I can buy in at decent prices. So we're going to look at ADC or Agree Realty. And before we do that, we need to look at what real estate investing is and specifically what a net lease is. So what is a net lease? The term net lease refers to a contractual agreement where a leasee or a renter pays a portion of all the taxes, insurance fees, and maintenance costs for a property in addition to rent. Net leases are commonly used for commercial real estate. So we can just look at the key takeaways here. In a net lease, the tenant pays a portion of all the taxes, insurance, fees, and maintenance costs for a property in addition to rent. Net leases are commonly used in the commercial real estate sector. Landlords use net leases when they don't want to deal with the hassles associated with ongoing maintenance and other costs. Types of net leases include single, net, double net, and triple net leases. So basically what this is saying is Agree Realty, which we will look at in a minute, is a REIT. It is a real estate investment trust, and it basically rents out commercial buildings to commercial tenants, and it charges them rent. Now, what is very interesting about ADC or Agree Realty is that they are a triple net lease REIT. They charge back to their tenants the taxes, insurance, and maintenance costs for a property. So let's say that I'm a tenant and I want to rent a building from them. If I rent a building from them, I have to pay the rent, but I also have to pay the maintenance costs for that building, the insurance for that building, and the property taxes associated with that building. So it's a very, very cool business model. And here you can see there's just some other definitions of what a single net and double lease is. But a single net lease is when a tenant signs and they pay one of the three expense categories that we looked at. So they might just pay the maintenance costs, or they might just pay the insurance. They might just pay the property taxes, but they only pay one. Now a double net lease is where they pay two of those expense categories, or a triple net lease is where they pay all three of those. And the lease terms are usually very long, usually 10 years or more. So that is what Agree Realty does. They are a REIT. They rent out these commercial buildings to commercial companies. So as you can see right here from the picture, that they rent out to Costco, they rent out to Sherwin-Williams, McDonald's, AutoZone, Home Depot, Lowe's, Walmart, Target, etc. So here's the Agree Realty in a snapshot. So the company, here's their share price, and this is as of June 2023. So the share price has changed. They have a market capitalization of $6 billion. They have 1,900 properties, and their tenants, which we will look at in a minute, are investment grade. 68%, so almost 70% of their tenants are investment grade. So we will look at that and what that means in a minute. Now let's look at their tenants. Their largest tenant or biggest tenant is Walmart. Almost 7% of their annualized base rent comes from Walmart. That is very stable and great to see as an investment in a REIT, because it tells me that Walmart is one of the largest stores or in the realty sector. They in the retail sector, and they pay them this percentage of rent, which is very stable. Then you have Dollar General, you have Best Buy, you have Kroger in here, Dollar Tree, you have Lowe's, Sherwin-Williams, Home Depot, AutoZone, Goodyear, etc. So to drive this point home, we can see the retail sectors here. So the percentage of their annual rent, 10% of that comes from grocery stores. Home improvement stores, almost 10%. Tire and auto, almost 10%. Dollar stores, almost 8%. Convenience stores, 7%. General merchandise, 6%. Off-price retail, 6%. Auto parts, 5.7%. Farm and rural supply, 5%. Consumer electronics, 4%. And other is 30%. So what this tells me is in real estate, you always want to try to build or have commercial properties that you know the steady cash flow is going to keep coming in. Your tenants will keep paying you. They will not go out of business, because you cannot have tenants that will go out of business. They won't be able to pay rent. You want to try to invest into commercial buildings that you can rent out to these stable businesses who are basically recession resistant or recession proof. And what I mean by that is, no matter what, if there's a recession, people have to go to Walmart. They have to buy their groceries, or they have to go to Kroger to buy their groceries. There's Home Depot and Lowe's. You need to go there for your building and home supply. Sherwin-Williams for your paint. The dollar store. Things are cheapest at the dollar store. AutoZone. Your car still needs to be repaired in a recession. Same with Goodyear. You still need tires. So these are very recession resilient tenants or recession-proof tenants. So here's that investment grade that they talked about. 68, almost 70% of their tenants are investment grade. What do they mean by that? There's a footnote here. I'm not sure if you can read it, but when an investment grade, that's a rating from S&P and Moody's, and those are the rating agencies. They are basically saying that these companies are investment grade. They are very high class. There's different ratings such as A, AAA, B, C, D, etc. The higher on the letter scale that you are, the AAA, that is a higher investment grade that you are. And that is saying that is the quality of these companies where you can have an investment in them and still feel safe. They have a very high credit rating, etc. So look at their tenants. Like we said, they have Lowe's, they have Costco in here. Costco's always busy. Amazon, Home Depot, AutoZone, Starbucks, 7-Elevens, Chick-fil-A's, Dollar Store, both dollar stores here, and Target. So very, very great tenants. And then here you have some other not rated tenants and some sub investment grade tenants, but the majority here being investment grade tenants. Here again, now they're just highlighting their national and super regional retailers. So they're industry leaders operating in e-commerce resistant sectors. So this means that these companies, are very resistant to e-commerce, online shopping and things like that. These companies will still be around for a while and they'll still be producing cash flows, and those cash flows will be used to pay the rents here. So again, you can have a snapshot here and see their tenants. 87% are national retailers. You have McDonald's here, again, Amazon, AutoZone, 7-Eleven, Starbucks, Costco. And then here you have some super regional such as Publix, you have some other ones, and then franchise. There's a 1% being a franchise, is Burger King, Taco Bell. Again, not a significant percentage at all. 87% national, that is what I want to see in a REIT. Ground leases. So these are really cool leases. I never really knew about these until I did some research. So ground leases are essentially what they sound like. So a REIT will buy a piece of land in a specific desirable area, and then they will rent that land, just the land, to a specific tenant. Now the tenant is responsible for the building construction, all the property or all the taxes associated with the property itself, all of the maintenance of the property, any insurances and things like that, and any leasehold improvements or improvements to the building. The tenant has to pay for that. So essentially, Agree Realty or ADC is just renting out the ground that the building is on. So that's why they say it's a very fee simple ownership, and the tenants have to make a significant investment. Now, why would a tenant want to go through the hassle of building all of this on top of the ground? Why wouldn't they just try to do it themselves? Well, the reason is, if there's a specific set of land that is desirable and a tenant cannot attain that land otherwise, they really have no choice other than to build there. Or if the tenant does not want to make the significant investment or more of an investment by purchasing the land on top of the building, they will vote to go towards a ground lease. So here we can see that about 208 leases in ground leases, makes up about 12% of their portfolio, and the average wait term for the lease is about 11 years. So it's a very long term. Again, great to see in a REIT. So their top ground lease investments, Lowe's being the biggest at 13%. You got Wawa, Walmart, Home Depot. You got some Wegmans, CarMax, Bank of America, CVS Pharmacy. All right, so their investment strategy. This is a decent slide. Agree leverages its 3 distinct investment platforms to target industry-leading retailers in e-commerce and recession-resistant sectors, like we spoke about before. They have a 3-pronged growth strategy, which they talk about here. So the 3 prongs are basically acquisitions, development, and partner capital solutions. Now, what they like to stress here is retailer relationships. So they engage in consistent dialogue to understand store performance and tenant sustainability. They leverage these relationships to identify the best risk-adjusted opportunities. So they're listening to their tenants, they're paying attention to their tenants, they're asking them how their business is going so that they can predict whether or not these opportunities or these buildings that they have for their tenants are meeting their tenants' needs, and if they're helping their businesses as well as Agree's business. So here they see the opportunities that they've reviewed. They say they've reviewed about 60 billion of opportunities since 2018, so in about 5 years, and they're very selective, and they've only got about 6 billion of that 60 billion. So they chose 1/10 of those opportunities to invest in because they vetted their process and they decided which ones would be the best for their company, and they went ahead with those. So again, very selective, and they're very disciplined in the investments that they make. Here again, there's some more items that they talk about here where they kind of say, oh, with competition, you'll have a strong market presence, real estate fundamentals, they stress demographics, access, visibility, the retail synergy, and again, they pick major retailers and strong traffic drivers. So again, here we can see some of their tenants. They have 162,000 net lease opportunities, and they're growing with these best in-class retailers. So they have grocery stores here, home improvement stores, tire and auto, convenience stores, dollar stores. This set of tenants right here, this is exactly what I want to see in a REIT. These are recession resistant or recession proof industries and retailers. General merchandise stores, off-price retail stores. They have some more auto stores, farm and rural stores, electronic stores, quick service restaurants, warehouse clubs, etc. So I encourage you to go and take a look at this. This again is their investor presentation. It's available right on their website, and it has all this detail in there. And the dividend. So invested in them for their dividend, and as we know, REITs, they pay a very high starting dividend yield, and they grow that dividend over time along with their free cash flow. So here we can see their dividend has grown at about 6+% over the past 10 years. So that's an awesome growth rate there for the dividend. And they have not missed a dividend payment in 135 consecutive common dividends paid. And their average AFFO, or their average funds from operations payout ratio, of 76% over the past 10 years. So usually when I look at a REIT, they're paying about 90% of their AFFO, or they have a higher payout ratio than 76%. So here they're at 76%. So they actually have a lot of room to keep growing this dividend. They can keep growing this dividend over time, and I would expect them to, because they have done so in the past, and nothing tells me otherwise that they won't. So that was Agree Realty. Now I want to look at what if we invested $10,000 into Agree Realty compared to the S&P 500 or SPY. So here we're going to look at a growth of $10,000 without reinvesting dividends. So here we can see that I took it over the starting in 2003, ending in 2023. That's about a 20-year period, and we can see that Agree Realty, or ADC, would have given you a total return of 320%. So it's pretty good. Average annual total return would have been 7.43%. Again, this is without dividends reinvested. If we look at the S&P 500, the benchmark here, they would have given you a total return of almost 400%, or an average annual total return of 8.3%. Again, this is without dividends reinvested. Now, what if we reinvested the dividends? How would that look? So here we can see, with dividends reinvested, ADC would have given you a total return of 744%, almost 745%, which equates to an average annual total return of 11.26%. So that dividend reinvestment here makes all the difference in the world. You can see by reinvesting that dividend, you would have averaged almost a 4% per year extra of total return. Now the S&P 500 in that same time frame would have given you an average annual total return of 9.50%. So that's 9.50% per year. So this, as you can see, S&P 500 here in this blue line on the graph, and the ADC right here in the black line, S&P underperformed ADC by about almost 2% or 1.7% per year over the past 20 years. So at the end of it, ADC would have had a better total return over this time period. Now, we need to remember that historical returns are not indicative of future returns, but this does give us a good idea of how well this company has performed over the past 20 years. So in summary, Agree Realty, I'm very excited about this company. Right when I saw this company, I thought of, Realty Income. Realty Income is basically the number one REIT. They're known as a monthly dividend company. And Agree Realty reminds me of a little brother or some type of relative to they basically are a smaller O in my opinion. And because of that, I think that they can have a much higher growth rate than O, which is more mature along in its business cycle. And Agree Realty is, as I said, as it's smaller, it has a easier path to growth in my opinion. And I like a lot of things about this company. They have a lot of room to grow their dividend. They're growing at high rates. They also pay their dividend monthly, similar to O, so that is great for income investors. And I've seen the past performance of Agree Realty, and I believe that they will be a strong addition to my portfolio. So if you enjoy this content, please please subscribe. I appreciate it. And thank you for watching. I hope you have a great day. Please note, I am not a financial advisor by any means, so please do your own due diligence when investing in companies. Investing is risky and you can always lose money, and I am not liable for any investment choices you make. Hope you enjoyed the content. Have a great day. Bye.